Good evening, everybody. Hello, how are we? What a great turnout. Look at all these wonderful people here to welcome in the new year. I'd say it's probably because we've got such a fine panel of experts standing up here. But before we do that, actually, some of you may not know, my name's Clive Lambert and I'm the Vice Chair of the Society of Technical Analysts, and we run yearly courses and exams, and once, if anybody achieves over a certain mark for for the exams, they are awarded with the Bronwyn Wood Memorial Prize, Bronwyn Wood being a former member of high standing who we've all got some very fond memories of. And last year, someone did exactly that and got 92%, and we've asked Andrew Watton to come along today and to accept his Bronwyn Wood certificate. So well done, Andrew. So excellent achievement there. I am now going to I'm going to stand up here again in a second for something else, but I will now put you in the capable hands of Mr. Gavin Wells.
Thank you very much, Clive. Good evening. Welcome to all of you. Thank you very much for coming on this wet and rainy and stormy evening. This is the first time that the Society of Technical Analysts and the ACI have jointly hosted an event which has historically been called the Square Mile Debate. The theme for this evening, very topical in light of Boris, Brexit, Donald's pending re-election or otherwise. Questions about what the markets will do this year are a theme for all of us. And so what better way to look at this than with our panel of experts? More on their expertise in a moment. Out of respect for your time and for theirs, we have, however, narrowed the field of the outlook for 2020 a little. Three main areas we've asked them to focus on, and in a moment we'll ask you to vote on each of those areas. We're going to ask you three questions and give you between 3 and 5 possible answers. Then, after that, each panellist will have 10 minutes to convince you why their particular views are the most relevant, be it from a technical or a fundamental perspective. After they've talked, we'll have some time for Q&A. If you don't ask them any questions, then I will. But hopefully you'll have lots to discuss with them. Then we'll have a vote again. We'll recast the vote to see whether they've swayed your opinion. Have they changed what you thought at the beginning? How relevant are their views? Once that's done, we'll have some closing remarks from Oliver Madden, President of ACI UK, and then we'll go through for drinks. Now, a couple of things you need to be aware of. First one is when you're asked questions, if you want to speak, you'll see microphones hidden behind your fold-out desks. To activate the microphones, you have to press the little button which makes the light go red, and then we can hear you. Press it when you're finished. Thank you, and press it when you finish, otherwise we'll hear the things you don't want us to hear. And the second thing is how to vote, which we'll come on to in a second with Clive. So that's the format of the evening. I'll introduce the panel in a second once we've had our vote. But to start us off, Clive, can I invite you back?
Okay. Keeping me busy tonight. Is everybody on the Wi-Fi? That would be useful because the way we vote, and so there's the Wi-Fi password. One Moorgate Place, and financial with a 1 instead of an I. Or you can just use good old 4G or 3G, or if you haven't got a smartphone, then you can't vote. Which is, you know, not my fault. So, if you are on the browser of your smartphone, can you please go to www.menti.com. Present. Look, big button in the corner there. www.menti.com. It will ask you for a meeting code. Put in 914730. Come on, you can do this. Financial with a 1 instead of an I. Second I. So Wi-Fi password is financial big F INANC 1AL. So are we okay? So we'll go back to this one. Look, there's already people voting. This is marvellous stuff. Okay, so that's your second part. Look, the votes are flying in. Where will euro sterling be at the end of 2020 is our first question. Above 93, between 83 and 93, between 75 and 83, or below 75. Okay, are we ready for the next question? Where will the dollar index be at the end of 2020? And you've got options above 100, between 93 and 100, between 89 and 93, or below 89 for the dollar index. What was the last trade on the dollar index? Esteemed panel of people that talk about this kind of thing.
96.60.
96.60 is the current price. Thank you, Tom. Okay, looks like we're slowing down now, so we'll ask the final question. Oh no, we're still going. Everybody good? Okay, we seem to have stalled, so last question. Which asset class will perform best in 2020? Equities, bonds, commodities, or cash? And that was what the panel asked me to ask. I threw cryptocurrencies in just to be mischievous. And people are voting for it, believe it or not. No big surprise there. Probably about another 10 votes, and then we can crack on with the listening to our experts.
Can't really choose basket of metals. I mean, soft metals. Rhodium's up 1,000%. What is rhodium? I know what rhodium is.
Okay, well, we'll come back. We'll revisit those results at the end and compare them to what we're going to vote for once we've listened to our esteemed panel. So I will pass you once again back to Gavin.
Thank you. To discuss these, or to bring some life to those questions you were just asked, our esteemed panel. Now, what's notable about them? The first thing is you might not know by looking at them, but between them they have over 100 years of market experience. Some would say I thought it was a lot more. But perhaps of more importance for tonight, and a rarity. I used to trade currencies, and we had varying views on research analysts, but the theoreticians was one of the comments. All three gentlemen in front of you have traded the markets as well as analysed them. They are practitioners as well as analysing or producing theories on the markets. So introducing each in turn. From the furthest end, Tom, for over 30 years, has been a technical analyst. We started as a technical analyst at S&P and then at Merrill Lynch. Then he became a portfolio manager and trader at a hedge fund where he co-managed a $2 billion fund, no small feat. He then became head of technical strategy at RBS. He was a managing director at Nomura. And a year ago, he founded his own company, Pelk Enterprises. Did I say that right?
Yes.
Good. Pelk Enterprises, advisory services to both financial institutions and high net worth individuals. Next to Tom, we have Adrian, also over 30 years in the markets. Adrian was the head of G10 FX strategy at RBS and Lloyds. He was chief European economist at Chase Manhattan. He also was a prop trader at a hedge fund and a portfolio manager. And he's now a senior FX strategist at Continuum Economics, focused on G10 FX. And finally, to my right, many of you will know Murray Gunn, head of global research for Elliott Wave International's Global Market Perspective. Prior to that, head of tech analysis at HSBC. He was a fund manager covering bonds, stocks and currencies are both Standard Life and ADIA. Now, to start us off for this evening, to give some context or relevance for those who feel that analysis doesn't really give much insight to the markets, Murray's very kindly agreed to show why we should all pay such credence to technical or fundamental analysis. He'll give us a brief introduction to that, and then we'll kick off with the 10-minute presentations from each of our panels. So, Murray, please join me in welcoming Murray Gunn to the mic.
Well, thank you, Gavin, and good evening, everyone. So we're here tonight to debate the markets based on the two dominant schools of thought, of course, technical analysis on the one side and fundamental analysis on the other side. Now, these two approaches may seem opposite and contradictory, but they are both tied together by the underlying driver of everything, and that, of course, is social mood. Now, of course, social mood waxes and wanes between positive and negative trends, and it's responsible for our behaviour, our likes, our dislikes, our politics, what clothes we want to wear, what buildings we build, what cars we drive, whether we buy or sell stocks, and also what music we listen to. So when social mood is positive, we like happy, upbeat music, and we like to buy stocks. And when social mood is negative, we prefer angry, harder types of genre music, and we like to sell stocks. Now, Elliott Wave International has known for decades about the relationship between popular culture and the stock market, but now we've got institutions like the Bank of England seeing such things as well. So as an introduction to this evening, here's how the stock market and our taste in music are linked.
We're gonna rock around the clock tonight. I'm all shook up. You know you make me wanna shout. Everybody's going surfing. City, here we go. I wanna hold your hand. You really got me. I'm into something good. That's twice and all things nice. Yummy, yummy, yummy. I got love in my tummy. Happy together. Life, I love you. Beautiful morning. Don't you want somebody to love? Excuse me while I kiss the sky. See the moon rising. Been days that confused. And the sign said, long-haired freaky people need not apply. Come and walk. No more, Mr. Nice Guy. Love hurts. And solitaire's the only game in town. All we are is dust in the wind. I am an anti-Christ. There's no way to go. I want to love you. Living in a material world. It's just what I have fun. Walking on sunshine. Everybody have fun tonight. Shake your love. Shut the right side. Pump up the jam. Roses and hearts. We got to let love roll. There is no other place I wanna be. I feel lucky. Looking for a party track. And I like it. I love it. All I wanna do is have some fun. I only wanna be with you. You were meant for me. If you wanna be my lover, as long as you love me. Me, baby, one more time. Rolling, rolling, rolling. Rolling, rolling, rolling.
Now, that took us up to the early noughties, and at the lows in 2002-03, we were listening to the hardcore stuff from 50 Cent and a band called Terror Squad. At the highs, just before the financial crash, it was all soft music stuff from the likes of Timberlake and Fergie. The edgy genres of Eminem and Lady Gaga we were listening to. They were popular in 2009. And most recently, after a decade of positive mood, we're humming away to the happiness of Ed Sheeran, Bruno Mars, and Drake. So I hope that's whetted your appetite for socioeconomics, and if it has, you can find out much more at socioeconomics.net, because this is the glue that binds all the markets analysis, whether it's fundamental or technical, together. Right, on to the main theme for this evening. And I'm going to make no apologies for the fact that my slides are very technical in nature, because I'm obviously here representing the technical analysis side, but rest assured the Elliott wave principle may look complicated, but it's pretty straightforward really. And if you go onto elliottwave.com, you'll be able to find out so much more about it. So let's start with the outlook for sterling. And here's a chart of sterling versus the dollar. So since its 2008 high, cable's been declining in what we think is an ending diagonal wave C, or a falling wedge, as some people might like to call it. One thing to note from this chart is that sterling was in a declining trend for many years before the 2016 Brexit referendum. And as we technical analysts appreciate, prices tend to move first before any news or event or reason becomes known. So the question is whether this ending diagonal is complete. And we think there's evidence, certainly evidence to suggest that it is. If you look at the bottom of the chart there, there's a clear five-wave advance from last year's low. And that's a very, very good clue that a major bottom in cable might well be in place at the moment. So as long as 119.59 holds on cable as support, we anticipate that it's in a bull trend now, and it should take it well up beyond 143.77 in all probability this year. So what about sterling versus the euro? Well, of the sideways action, all of the sideways action from 2016, we think constitutes a B wave correction and it's coming after an impulsive directional move higher. So euro sterling at the moment looks like it's either bottomed or it needs a marginal new low in order to do so. But either way, the next significant move in euro sterling should be a major advance in wave C. And of course that means a weaker sterling versus the euro. Now if this wave count is correct, then we should see parity in euro sterling, perhaps not this year, but certainly that is the direction of travel as far as our Elliott wave analysis is concerned. And versus the yen, the Elliott wave structure for sterling yen suggests that sterling still has potential to advance in the short term as it completes a similar sideways wave B correction. So again, like euro sterling, the main point from this chart is that the higher degree of trend for sterling yen is down. So in conclusion for sterling, we've got sterling advancing versus the dollar, but declining versus the euro and yen. So on a net basis, what we see for sterling in 2020 is a slight decline in the sterling index overall. So now on to the dollar. And this chart shows the broad dollar trade weighted index from the early 1970s. And I think you'll agree it's a pretty clear five-wave movement into the top in the early noughties. And it's really interesting to note that wave 5 equaled a golden ratio 1.618 times the level of wave 1 through 3. And that's a tendency in wave structure that was recognized almost 90 years ago by R.N. Elliott. And when we see it on this large degree of trend, we can really see its value. And it gives us a clue that that high in the early noughties was really significant for the broad dollar index. So since that top, the down up movement in the dollar constitutes, from what we think as waves A and B, of a flat correction. And that means that the next wave in the dollar should be a decline in wave C. Now, the popular dollar index, or DXY as we all know it, is the one we all look at, of course. And it's quite different from the broad dollar index. And it looks like it's actually already topped out back in 2017. So the Elliott wave structure for the DXY suggests to us that it's completed completed a corrective advance over the last couple of years, and it's set up for a major decline this year. Now, the DXY is heavily weighted, as no doubt everyone knows, to the European currencies, of course, and so the wave structure is very similar to Eurodollar and the DXY. So in Eurodollar, the October 2019 low of 108.79 should represent a major low in Eurodollar, and we're certainly looking for a move higher in Eurodollar to take us back above 125.55 at least this year. And it's worth noting as well that this last year's range in Eurodollar was the tightest range in that synthetic currency pair going back that long, of course, but it's the tightest range that it's been for 47 years. And so the potential for a very powerful volatility breakout extended trend is extremely high. And lastly, on the dollar, its structure versus the yen looks extremely bearish. All of the sideways price action from 2016 to last year, it counts well as a wave B triangle, and so a thrust lower in wave C should now be underway. Now, this chart is slightly out of date because the market has edged a little bit higher than our wave 2 label on this chart, but it hasn't altered the overall bearish structure. So wave C in dollar yen equals wave A at 85.57, and so that represents a very viable target as far as we're concerned in dollar yen. So in conclusion, for the dollar, therefore, our current outlook is that we see a large decline in the dollar in 2020. As for the question of which asset class should perform best in 2020, well, I'd like to start by showing this chart of the inflation-adjusted US stock market. Now, from the early 1900s up until around 1990, the inflation-adjusted Dow, as we can see, meandered relatively sideways. And this could be considered a normal state of affairs. The growth of prices in an economy, whether they be goods and services, commodities, or asset prices, are all broadly aligning. But since the early 1990s, of course, something absolutely extraordinary has happened. The inflation-adjusted US stock market has ballooned higher to an incredible historical extent. So any sensible person, I think, looking at this chart would surely conclude that there's a bubble in asset prices. But that's not all. Let's look at the US stock market relative to GDP. Now, this is the Wilshire 5000 index as a percentage of GDP, and it's this measurement is the fundamentalist's hero, Warren Buffett's favorite measure of overall value. So we can see the extent of the bubble in stocks back in 2000 and also the relative value back in 2009. But look at what's happened since 2009. On this measurement, the stock market is now as overvalued as it was 20 years ago at the height of the TMT bubble. And this overvaluation is coinciding with a mature bull market in terms of the Elliott wave structure. Our thesis at the moment is that the US stock market from 2018 to 2019, the sideways movement was a fourth wave correction. And so wave 5 is now in progress. In fact, wave 5 may be very close to actually ending. This means that a new bear market appears pretty imminent. Now, sentiment is incredibly bullish. We've got a record low cash to assets ratio in US mutual funds. The Ridex bull-bear ratio is at all-time high. The put-call ratio is the most bullish since January 2018. Loss-making IPOs are the highest percent of the total IPOs since 2000. The top 5 S&P 500 stocks market cap is the highest percent of the total S&P market cap since 1999. And the Fed liquidity boost, if you look at that chart, which I don't show here, it totally eclipses that seen before the 2000 top and just before the 2008 crash. And it's interesting to note, of course, that tomorrow we get the US-China trade deal being signed to great fanfare and trumpet blowing. The stock market's bottom on terrible news, when everything is bleak, dark, and very bearish. And the top on great news, when everything is rosy. So it's going to be really interesting when we look back in a few months' time to see whether the trade deal signing tomorrow corresponded with a stock market top. All of which finally brings me to the best performing asset class of this year. Now, this chart shows the world stock market since 2009, and it's advanced by 300%. Now, when stock market values are rising, the value of cash is obviously declining. So what do we do to see a chart of cash? Well, we simply flip the chart. And so, given that we anticipate a declining US stock market, which of course is the major factor in the world stock market, we think the best performing asset class of 2020 is going to be cash. As the old saying goes, turnover is vanity, profit is sanity, but cash is king. And this year we think it will be again. So thanks for listening, everybody, and check out our websites if you want to know more. Thank you.
Thank you very much, Murray. So that's buy cable, buy euro sterling, sell dollar yen, buy euro dollar, sell the dollar, sell stocks, hold on to your cash. I think I can keep all that. Brilliant. Adrian, over to you, please.
Right. First thing I've got to work out is how to work this. Oh, here we go. So, yeah, good evening, everyone. Gavin introduced me very nicely earlier, and I have to say I'm pleased to be speaking at the ACI again. First time I did that was about 30-odd years ago in Abu Dhabi. It was actually one of my first speeches. So I was pleased to be invited. It was only after I was invited that I found out that it was also an STA function. And I've now found I'm a filling in a technical analyst sandwich. But not get to try it. But I'll do my best. I'll do my best to distract you from the dark side. I haven't brought my lightsaber, but all I can hope is they haven't set up a wicker man for me outside. I'm going to go backwards. So I'm going to start with the asset allocation. So this is our view of, I'm going to put my glasses on actually. This is our view of assets for this year. And in terms of performance, the best performing assets in the G10 space, which is what I look at, we think will probably be European and UK equities. Now, I take what Murray said, and I agree with most of it, actually. But European equities aren't as overvalued as the US. While the US has surged upwards and onwards since 2009, the Eurostoxx 50 hasn't yet broken 2015 highs, or much less 2008. So we still think there's some value there, and obviously valuations are much lower. From an economic perspective, we think we're going to see a bit of a slowdown in the US, but Europe might do a little bit of a speed up. Now, when I say a little bit, I mean a little bit, like from 1.1 to 1.2. That's not flattered by the shape of it, and we think it'll look a little bit better still in 2021. So by the time we get to the end of the year, it'll look a little bit better. We think the US stock market will be protected by the fact that the Fed still have scope to ease. And of course, part of the reason valuation is so high is because interest rates are very low, and we think they can still go lower. So actually, there might be some competition for European equities from US government bonds if we do see a couple of Fed eases this year. One might come early 2021 instead. But because we think the dollar is going to be a little bit weaker, on aggregate, we're looking for European equities to do better. So I'm going to go backwards, as I say, and now look at Eurodollar. I haven't looked at the dollar index because, as Murray pointed out, most of it's Eurodollar anyway. And I'm going to start with the chart on the left, which is probably a chart that you've seen before in one form or another. This is in real terms. I've got the Bund T-note spread on the left-hand axis against the real measure of euro-dollar. I can't remember what I've indexed to, but it's basically roundabout now on the right-hand axis. It doesn't look that different from the nominal story. The underlying story is clear enough, though, that the likelihood is we're going to need to see a turn in the Bund T-note spread if we're going to see a turn in euro-dollar. Now, we think we will see that. We think we've started to see it already, as you see. But it will extend, we think, towards the end of the year as the Fed starts to cut rates and as the European economy shows a bit more signs of stabilisation. Obviously, there are risks. The European manufacturing side looks a bit iffy, but that has started to stabilise as well. And as that happens, we think by the end of the year we'll start to see euro-dollar turn higher. Now, not much. It's quite possible not much happens in the first half of the year because we think first quarter is going to be okay in the US. We're not going to see any particularly rapid growth in Europe either. And if we see stability, then as we've seen of late, when volatility is low, you tend to see the high yielders do better. So the dollar might actually have some brief outperformance earlier on in the year. But by the end of the year, we'd expect to see the euro start to rise. Of course, one thing this also highlights is how high the dollar is by historic standards. In real terms, we are very close to the all-time highs at the time for the euro. I haven't gone back as far as 1999. The lows are a little bit lower in real terms, but not a great deal. But on top of this, I just had to point at the other chart, which looks a bit messy, but does give, I think, some guide as to why we might see some deviations from the chart on the left. As you can see, it wasn't always the case that euro-dollar reacted immediately when we saw interest rates move. And that's because the FX markets, as you know, aren't just about interest rates. The FX markets balance the capital, the financial, and the current account. And one of the points about euro-dollar is that the euro is a big current account surplus area, and all the time that we see the dollar go up, all the time even that we see the dollar stay stable, we have to see money flow from the Eurozone out and to the US in order to balance the current account flow going the other way. Now, in general, in the last few years, that's tended to happen via portfolio flows into bonds and to a lesser extent equities. And what the right-hand chart shows is that the difference between basically other investments. So when the current account isn't entirely funded by portfolio flows, you see it funded by other investment or hot money. And typically, on average, that follows euro-dollar or moves with euro-dollar. Now, other investment has started to be quite a big funder of the US current account deficit in the last year or so, which because portfolio flows have stopped moving as rapidly out of Europe. And that does suggest we might see some outperformance start to come for the euro a little bit earlier than you might expect. So that's something to watch out for, but we actually expect about 115 by the end of the year and about 120 by the end of next year. So nothing hugely dramatic, but it could go a bit faster than we expect. Sterling. Now, I've got a chart about valuation here, and I've decided to look at sterling yen. I didn't have as many charts as Murray because I was told we were only allowed 3 slides. He managed to have, 25 in his 3 slides, but I've only got 3. But anyway, I've got sterling yen because I think it's the prettiest. Now, a lot of people, the perception of sterling, I mean, people who are sterling bullish tend to say, well, sterling's cheap. And against the dollar, it is kind of cheap. Around about 130 is low by historic standards. But of course, 130 now isn't the same as 130 10 years ago. If you remember, we had quite a period of high inflation around about the financial crisis. So actually 130 now is equivalent to about 150 10, 15 years ago. Purchasing power parity is about 130 for cable, depending which measure you use. So actually we're not that. I mean, historically sterling has tended to trade a little bit above purchasing power parity against the dollar. So I would still say, yes, it is a little cheap against the dollar, but that's mostly because the dollar's very expensive. It's not because sterling's particularly cheap. And that's why I've got sterling yen here, because this is a chart of sterling yen spot, the orange line, against sterling yen PPP, which is the blue line. As you can see, sterling yen PPP has been falling quite rapidly since, well, forever really, because inflation in Japan is generally a lot lower than inflation here. Now, I wouldn't suggest that everything should trade at purchasing power parity. That's not what I'm saying. What I'm saying is the difference should be looked at as an indicator of value. So historically, we've tended to trade actually fairly close to purchasing power parity against the yen. We're currently trading about 10% above it. So if anything, sterling is rather expensive against the yen. And it's not as if, I mean, although we offer some slightly greater nominal yield, we actually don't offer any greater real yield. So I think that suggests that people who think sterling is cheap, well, it's cheap against the dollar, which is expensive. But the dollar's expensive against everything. It's not cheap against the yen, and it's not particularly cheap against the euro either. I could show a similar sort of chart for euro sterling. The right-hand chart actually is a bit more short-term in nature, but I think, this is why I've used sterling yen really, because it works more nicely than any of the others. And what it shows is the 10-year spread between gilts and JGBs, which is the orange line, against sterling yen, which is the blue line. And over the last few years, basically since before the referendum, we've basically been moving with the spread until basically October, when optimism about something has started to push sterling yen high. Now, some of that's yen, perhaps, but then we have had strong equities throughout this whole period, so I don't think you can really put it on the side of the yen. It's more about sterling, it's more about some sort of optimism about the election, perhaps, or the fact that we're going to get Brexit done, or something of that sort, seems to have boosted it. But what I would say is that from a Brexit perspective, we don't think, well, we are going to get it done in some sense on January 31st, but the wrangling will continue certainly through this year, probably for many years, and not much is going to get sorted out that's going to change anything over the next year. I think the perception that there's a reduction in political uncertainty may well have helped sterling, but of course there was no real point at which the market priced in the risk of a Labour government. As you can see, it just tended to follow yield spreads. It stopped following yield spreads. I think incorrectly. I think by the time we get to the end of the year, we'll see sterling yen back around 130. So I think sterling's going to weaken against the yen. It's going to weaken against the euro, which we think is going to be up at around 0.88. It will probably go up against the dollar eventually. I wouldn't disagree with Murray that we've probably bottomed out, but I think the rise will be a bit slower than he's suggesting. Too many things still to be sorted out. Is that my 10 minutes? I think that's about my 10 minutes.
What did I say? Yes, about 12.
Oh, okay.
But I was being gentlemanly and I was very engaged in your presentation.
Thank you, everyone.
Now, as you all know, bread is essential to any sandwich, but it's the filling that's really yummy. So now we welcome the last bit of the bread. To give us his technical view, please welcome Tom.
Thank you. Is this working, the microphone okay? Yep. Thank you. So if we go back to last August, and I looked in the mirror, scary thought, my hair was showing signs of recession. My waistline was showing signs of years of excess, and the combination of these two factors had the potential of taking me to a deep depression. And that's where we were a short time ago in August when bond yields had a massive move lower. If you remember, we hit all-time lows in bond yields. PMI data was looking pretty poor from a fundamental point of view. We had a 50 basis point decline in 10-year treasuries, and everyone thought it was all gloom and doom. And then when we come forward to where we are today, the world looks a slightly different place. PMIs have turned up, 2s, 5s, 10s, break-evens in the US have improved, stock market's making fresh highs, but we can't look at the market the same today as we have done in the past, particularly from a technical perspective. When you read technical books, it all tells you about liquidity, where market trades on volume. Well, we've had an unusual scenario in the markets that we've never seen before, where we've had a liquidity trap from the US, an expansion of the balance sheet from the US, as we're seeing going forward, going up to maybe $4.5 trillion this summer. That money has to go somewhere. Equities have gone up. Why? As we know, equity risk premium was low. Bond yields gave you no return, so you bought stocks. If you're a company long cash, you buy back your stock because it's cheap to do so. CapEx was actually negative last year in the US. So people weren't investing in R&D. They're actually just buying back their stock. So what does that mean going forward into, well, I just deleted myself now. There we go. That's my chart. So the first chart I'm going to start off with is the UK Broad Trade Weighted Index. And I've highlighted on there some past events which have been major in determining moves in the market. And I've chosen to look at the markets from a cyclical perspective. So I've put in here a Fourier transform at the bottom, which are the sine waves. We've got three dominant cycles, in my view, going on in the market, 559, 275, and 138-week cycles. When these cycles converge, which we call technically nesting, for those that have done their technical exams, where you circled in red at the bottom, this is typically where you get major turn events in the value of sterling. Anyone that's got any technical ability would realize that the peak in sterling that we rebounded at 0.618 retracement back in 2015-16. And we are on the verge of forming a potential double bottom base in sterling, which suggests going forward, there's a potential 9% rise in the value in sterling in time. But the problem with doing a one-year forecast or any long-term forecast is markets don't go in one direction. When we look back at what happened with the UK Brexit result here on the right-hand side, when we had that massive decline, I remember that night I was sitting up watching it on telly, and I was actually a Remainer, and I was quite sad to see the result. Even Nigel Farage, who actually lives in my village, and his daughter was at school with my daughter, sadly. And actually, it was quite a depressing result from my point of view. Now, the next day, sterling, as we can see, had a massive decline. But I was seeing my mother-in-law, who's of the demographic typical Brexit voter I would classify her, and she said, look, it's not so bad. Look at the newspapers. The stock market's up. The FTSE 100 is doing okay. I was like, well, you always have to look at the currency. You know, the FTSE 100 has a lot of companies that export. So in sterling terms, if sterling weakens, those stocks benefit. And you know the moral of that story, what's the difference between in-laws and outlaws? Yeah? Outlaws are wanted, right? Anyway, but that's how we go. So first of all, when we look at that chart there, I think there's a very compelling story for the long-term play to be sterling positive. The key thing, as two eloquent speakers have mentioned, depends on which currency pairs you want to play that strength. And I think the cable story is quite compelling. So first of all, I would argue that actually sterling has one more leg of weakness to come, mainly because I see a double whammy of some dollar strength, which we'll look at the dollar chart next. So first of all, I wouldn't be surprised if we have a leg lower in cable, and it could go lower than people suspect. And I'm talking about levels towards 126.5, those kind of levels from where we are at the moment. We're only at 129.60 the other day on the threat of potential rate cuts in the UK looming, and looking at the voting members' behaviour. So I think there's one leg of potential weakness to come, which may catch some people out who are committed sterling bulls. But anything with a sort of a 125 handle, I would personally fill my boots in that particular currency bear, and I think we go higher longer term. Where do I see the real pickup in volatility plus sterling momentum to the upside? I think that comes after June. So the way I look at the markets from a cyclical perspective, the second half of the year is going to be much more interesting than the first half of the year. I think volatility and directional breakouts surface into the summer. The next slide is the dollar index. Remember, this is 55% weighted in euro terms, so it's like mirroring euro dollar. I would actually suggest there's one missing leg of dollar strength to come. So most commentators, when I watch the news and read the news wires, suggests, dollar this year is bearish, and I understand the narratives for that. But I wouldn't be surprised if there's a missing leg where we retest those highs up at 100. And I think that could be quite painful for people that are committed to a bearish view on the dollar. You get one more leg up, which means cable potentially goes down to that 126, 125.5 area. And then you get the leg down of dollar weakness later this year. And I would suggest, again, timing-wise, that would really surface around August. Now, why would I say August? August is the best time to be long-end treasury markets. It has worked in the last 15 years, 14 years. When I go to see clients and I say, if you buy long-end treasuries in calendar weeks 32 to 34 and close your eyes, you make on average 31 to 50 basis points in that 3-week window. 2s, 10s normally flattens by 21 basis points, and the 2s, 10s, 30s fly flattens on average around 16 basis points in August. But also that weakens the dollar at that time. So a good time to fade the dollar for volatile big moves is typically in line with the move in bond markets, and that's going to be from August onwards, I would suggest. And remember what happened this last August? We had the biggest move in bond markets in that August 3 weeks kind of curves flattened aggressively. We had inversion in the curve. Even the UK 2s, 10s curve inverted briefly. What we didn't mention is China. And China is going to be very important going forward this year. I don't have any slides on China, but China, I pay close attention to the currency and I pay close attention to the bond market. China has a risk of upsetting the expectations of people on trade agreements after the first agreement that's coming tomorrow. But the Chinese currency is extremely important. I mean, dollar China is now below 7, right? If dollar China goes up, i.e. weakening Chinese currency, that exports deflation into Europe. So if you're looking for any growth in Europe, you need to see a stronger Chinese currency exporting some inflation. So from a cyclical point of view, I think the dollar, one more leg up before you want to strategically fade the dollar. And the last slide is on commodities. We were asked to choose our best favored asset class. I wouldn't say this is going to be the best asset class, but it's what I'm long PA, so I'm talking my own book. But also, I mean, there are many asset classes that I think are going to do well this year. For example, I think Chinese municipal bonds are a great investment if it's anything that anyone's into. That's going to do particularly well. Does anyone left field, anyone ever invest in comics? Have you paid any attention to the trend in comics or rare gold coins? These are all the things that I think are very interesting on a PA basis. But from something on a financial basis, I've put in a couple of charts here. First of all, on the top right, you have the Bloomberg Commodity Index. So for any sort of simple technician, you can see there's a classic inverse head and shoulders. And what I'm going to suggest to you is this: I think there's a beginning of a turn up in certain commodity markets. And I think particularly some of the metals are extremely interesting. One of my main clients is actually very heavily exposed to commodity prices. So I'm looking at commodities which is a little bit out of my comfort zone, and it sort of raised my attention because I was like, hang on a minute, these are all breaking to the upside. This looks really interesting in commodity space. Remember, you always got to put things in the context of currency terms, right? So when we look at the lower right chart, which is what I've been sort of singing my own trumpet, rhodium is up 1,000% in the last 3.5 years. We can talk later about what rhodium's doing, but this was one I've been recommending to people for the last 2-3 years, and that's had amazing move. Since I created this chart, it's actually gone up $2,000, and I sent this chart last week. Just shows you how much this thing can move, right? It was trading at $6,000 the other week, then it went up to $8,200 a couple of days ago. So if you want to see some beta trades, this is one. Everyone talks about cryptocurrencies 9 million% in 10 years. Well, how many people bought it 10 years ago in this room? Well, if they are, I don't know what they're doing sitting here anyway. The chart on the top left is gold, right? And this is gold in dollar terms. The pickup in gold, although we had the geopolitical tension events which drove the move higher, actually worked beautifully with my cycles. So where we had the convergence of those cycles there, actually caught beautifully that spike up in the gold price. Now, there's a very simple reason, it's got nothing to do with technicals, why I think gold's going to be up a lot. Not only this year, but in the next 10 years, monster. And that's simply China. If you look at the bottom left, there's some statistics about GDP, foreign reserves in percentage terms. US is at the top of the table at 8,100 metric tons, and China is in the middle there at 1,800 metric tons. China has an agenda to equal the gold to GDP ratio of the US, which means they have to buy a lot of the yellow metal. It's as simple as that. In the last 6 months, it's been the biggest movement from central banks to buy gold in the history of buying gold in the last 6 months. Now, gold is a manipulated market. I've got to be careful what I say. But the more you know about banking, the more you know how it's all not quite a straight game. I've got to be very careful what I say. But basically, the more you know how it all works, the more you start to understand it. So the low in gold that we had a few years ago, when it got down to just shy of $1,000, and this is being recorded, so actually I'm going to scrub that. Anyway, there was a reason why it got down to that level, okay, and that was driven artificially down to the cost curve price by a very large central bank selling gold, which they didn't have to replace in their vaults, okay? And so they sold 3 times as many futures contracts as there was gold available and drove the price down to the cost curve price and then bought back the gold, okay? You can guess which central bank that was. But the key thing is, where am I wrong? So what's the upside for gold to finish off? So I have a stop at 1407. It's very important to know where you're wrong. That's what the advantage of technical. My wife taught me that. She said, Tom, you should embrace your mistakes. And I said, you're right. So I gave her a big hug. So 1407 is the level where if I'm wrong, it goes below that. We're trading around 1550, 1540 at the moment. On the upside, I've got targets at 1780, 1620, got there not recently, very close, 1610. But long term, if you remember where the gold price was, at 1820 spot 6 was the all-time high. Sorry, 1920 spot 6 was the all-time high. I think if you take a longer term view than 1 year, gold is going to go a lot higher.
And with that, I'm afraid I have to butt in.
And that's it.
To be fair. Thank you very much, Tom. Excellent. So we know that we're buying lots of things after we've sold them briefly for the first couple of months, but then from the summer we're long. Questions from the audience. We're going to run the poll again to see if your mood has changed. Any questions for our distinguished panel before we do that? If you have a question, please raise your hand. I'll point to you and then you can click your mic. Sorry, yes, sir, you with a fine beard.
Is that okay?
Yes.
Brilliant.
Fine, okay. Question for Murray. Gold. Is Elliott Wave's view still that we're in a big ABC? We're currently in a C wave up, and then it's going to go down?
Yes, that's correct. We view the recent rally in gold as being corrective in nature. So it's, from an Elliott Wave perspective, at least it's topping out at the moment as far as we're concerned. And so the next trend should be down in gold. And that's obviously against the consensus, but that a lot of times that's what Elliott Wave gives you the advantage of seeing those turns in terms of the structure before they happen. I take on board what Tom is saying about central banks buying gold, but if you look at the history of central banks buying gold, maybe not China, but certainly other central banks buying gold, they tend to time it at the wrong time. So tend to sell gold at the bottom and buy gold at the top. So that's another aspect which is kind of adding to the Elliott Wave structural view. Yeah.
Thank you, Murray. Any other questions from the audience? Yes. No, that gentleman at the back.
Yeah, hi. Question for Murray, actually.
So I'll just say it afterwards. I can hear it from here. He's got a lovely booming voice. Please go ahead.
As a technical analyst, don't you believe in the trend is your friend?
As-
You said that yesterday. Certainly. I mean, I love Ed Sakota, and I think it was Ed that said the trend is your friend until the end when it bends. And absolutely. The great thing about Elliott Wave is that it's an all-encompassing methodology of looking at the market. So it can give us lead indicators of turning points, and it can give us the times that we should be going with the trend as well in, say, a third wave, either higher or lower. But so yes, I mean, we can't rule out the possibility that this is going to be an extended fifth wave in the stock market. So that's why when we write our reports, we always give the risk levels and saying that, the great thing about Elliott Wave is that people look at it as being kind of subjective. It's actually very objective, because we know that if certain levels are broken, then we know that the trend is from an objective point of view, it's breaking down. So until those levels are broken, then we have to say that there's a risk that the trend continues higher. But from a overall perspective, from a fractal analysis perspective, looking all the way back over 100 years of data, given all the sentiment indicators as well, which you overlay on the analysis, it certainly looks toppy at the moment. And don't forget that it's been, everyone keeps talking about a record US expansion. It's 10 years, the longest record US expansion in US history. It's fantastic. I mean, the Fed talk about it being mid-cycle. Well, okay, but are they looking at history? I mean, it's the longest expansion in history already, over 10 years. So it doesn't have to end just because of that, obviously, but if you look at the data, then you would see that the risks are that it does.
Thank you, Murray. Can we do the poll? I don't want to keep you away from your drinks or hold people who have to rush off, so trying to keep to timing. We were going to have closing statements from these three gentlemen, but could I suggest we do the poll again, because that may be of interest. Then we've got the President of the ACI to say a few closing words, but then we're all going to the bar where you can nail these people on where to put your cash. So, Clive, if you could come up.
Have minds been changed? That's what we want to know, do we? Let's do the poll again. No, hang on a minute. I can't remember what I did. Right, so there we go. All back on your phones and vote again. Where will euro sterling be at the end of 2020? I think we reached about 50 votes. Just about above 50 votes last time, didn't we, on each poll? So.
Everyone's gone bullish sterling. We were all bearish.
Okay, final votes, please. Okay. So that's the next. Oh, we're still going. Come on, hurry up, you lot. Okay. Where will the dollar index be at the end of 2020? First vote for above 100. There we go. No, you can't. Okay, so between 89 and 93 wins the day there. Which asset class will perform best? So I think we definitely had, I think equities were definitely winning this one on the first time round. Murray. Maybe something you said, Murray.
They're all following Tom.
That means we're going to lose money.
You've always
Okay,
carried more
well,
weight than me, Tom.
So we all want to be in the commodities game.
Get bigger the house with personality.
Okay, right. That's quite a big change from first time round, I think. So Mr. Pelk's had his say. How do you prefer to look at the market? Fundamentals, technicals, both? Or the other option I've given you is neither, stroke, flip a coin? And we've got one coin flipper. There you go. And just on a personal note, that is for me the most pleasing result, to see that people are very happy. You know, and I hope Adrian's heart feels good. You know, so you're not going to get lynched, because most people would use both anyway.
Excellent.
I'll pass it back to Gavin. Thank you very much, everyone. Cheers.
That is quite heartening to see. As an ex-trader, the fact that people should use all available information to them, and the fact that these gentlemen's views have informed your opinions as to where you'll put your money this year. Thank you all very much for your time. I'm sorry the questions were so short, particularly this gentleman in the front, but you will have a chance to talk to our panel at the bar. And for now, if I could ask Oliver Madden, who's the president of the ACI UK, to come and say a few closing words, and then we'll invite you to move next door. Oliver.
Good evening, ladies and gentlemen. 6 months ago, the ACI UK and the STA signed a memorandum of understanding because we both share a commitment to education and professional development. Our goal was a simple one: to collaborate on informative and insightful events for our members, and I think we can all agree that the start of our partnership has got off to a fantastic start this evening. I'd like to thank firstly Gavin and Murray and Adrian and Tom for their views and very interesting insights. I'd also like to just thank those that put on this evening's event, a very excellently organised evening. And I'd also like to thank you for taking time out of your evenings to come along and attend. Obviously these events are here for you, our members, and it's great to see so many of you here this evening. So thank you very much again, and look forward to speaking to many of you in the bar shortly. Thank you.